What's up, you guys? It's Paul here. Now, if you've been watching any investing news lately, you probably saw this article which came out on Friday, which showed that Berkshire Hathaway finally makes a bet on gold market that Warren Buffett once mocked. Okay? Now, the reason this is big news is because in the past, Warren Buffett cautioned against investing in metal because it's not productive like a farm or a company, okay? He always used to mock it, saying that it's just a metal that sits on the ground and doesn't really produce anything like a company would. It cannot really increase profits. It cannot expand into other industries. It cannot do anything like a company can do to increase its value, which was exactly why he always cautioned against investing in that metal and preferred productive companies like Coca-Cola, okay? But now, as gold miners are benefiting from surging bullion prices, which is the price of gold, because the value of these bullion prices are boosting their profit margins as the cost of productions have steadied, okay? And that's exactly what's making them increasingly attractive investments. Okay, and this is what led Berkshire Hathaway to open up a big stake in Barrick Gold, where they bought about 20.9 million shares of it, or 1.2% of the company's outstanding stock, and which this is a market value of $565 million. Okay. Now, to give you a brief history of why this is important for you to know, it's that gold has always been the reserve currency, okay? That's what always represented real value because it's real asset. Gold and even other precious metals like silver. And any currency like the dollar or the pound or whatever it is always represented the value of gold, okay? So the more the Fed keeps printing money and the more money there is, the cheaper it becomes or the less valuable it becomes, because unlike printing money, you cannot really print gold, and so it's a finite resource, okay? But if the currency which represents the value of gold keeps multiplying and they keep printing it without real economy pushing the value of the dollar, for example, the value of the dollar will keep dropping, and that's how it will create a lot of inflation, okay? Now, anytime the Fed reduces interest rates, companies benefit from it because lower interest rate mean that the companies can borrow money at a lower interest rate, and that helps them increase their revenue, make more profits, and make the company more valuable, okay? Now, on top of lower interest rates, if the Fed keeps printing money, that's artificially propping up the economy and artificially helping companies do extremely well, okay? Now, if you know how the stock market works, any equities or stock represent the future value of the company, okay? So when there's low interest rates and a lot of money printing, propping up the economy, there's already a lot of optimism and a lot of profits already priced in, okay? And the way you can visualize this is to look at what is called a PE ratio. Now, this is called a Shiller PE ratio, which essentially shows you what the profits to earning ratio has been for the S&P 500 index over the last century or more, okay? Now, anytime PE ratio has been extraordinarily high, that's exactly when you see a massive crash like this, okay? Now, the most recent time that it happened was obviously the tech bubble, just around 2000, and right after it reached the outrageous value of around 44, it crashed terribly. And if you actually look at the SPY, which is the S&P 500, if you look at it at all-time highs between 2000, it took it nearly 10 years to get back to that same value, okay? Can you imagine putting your money in the S&P 500 index and not making any profit for 10 years? That would be absolutely ridiculous. Now, here's where this gets really interesting. If you look at the previous gold bull markets, this bull market from 2000 to 2012 started right at the end of the tech bubble, okay? Now, between 2000 to 2012, gold had gone up over 500%, okay? Nearly 600% at the peak. And that's exactly why you need to understand the relationship between the gold bull markets and the S&P 500 index, okay? Now, if going back to this PE ratio, right now we're at 31 for the S&P 500 index, which is far above the median, which is around 15.8 here. Now, I'm not saying that the market will crash, because people probably have been predicting that it'll keep crashing at all of these peak points. Anytime you saw a little bit of a drop, people were expecting this massive crash, but it didn't necessarily happen, okay? So it's at times like this that Instead of selling out of stocks and missing out on further growth, what I actually do myself and what I would recommend would be to actually diversify your portfolio rather into real assets like gold and silver. Okay, and based on that correlation that you saw in these gold bull markets, if there is a potential crash, that could be the beginning of a new gold bull market. Okay. Now, the new gold bull market actually started in 2015 here. If you look at GLD, which tracks the value of gold, around 2015 it was $111, and in the last 5 years it has gone up 64%. Okay, now that's the value of gold. But the real value, in my opinion, is not just in gold, but just like how Warren Buffett is investing in Barrick Gold, which is a gold miner, they have shot up far more. Okay, so let's look at some gold miner ETFs. Now, the VanEck Vectors Gold Miners ETF is one of the ETFs that I'm following right now, which has done extremely well in the last 5 years. If you see here, it was trading as low as $15, and in the last 5 years, it has gone up 162%. Okay, this is the start of a new bull market. It doesn't mean it's going to end here. It may go for another 5 or 10 years, like the previous gold bull market. Another ETF that I'm looking at is called Ring. Same thing here. If you look at the last 5 years, even Ring has gone up around 173%. Okay, and that's exactly how I'm looking at gold right now. Now, to look at the portfolio of this ETF, I'm here on Morningstar and I'm looking at the Ring ETF. If you look at its performance over the last 5 years, it's been averaging almost 25% per year. To be able to get 25% per year for 5 years, that's pretty amazing. And I'm pretty sure this is not going to stop anytime soon, okay? To actually look at the portfolio within it, its top two holdings are Newmont Corporation and Barrick Gold. And Barrick Gold is exactly what Warren Buffett bought into, okay? Now, both Newmont and Barrick Gold are two stocks that I'm personally investing in, and I think that they will continue to outperform among all the miner stocks. If you look at the VanEck Vectors Gold Miner ETF, ticker symbol GDX, even this has been doing about 23.5% for the last 5 years. If you look within the portfolio, it's very similar to the Ring ETF, with Newmont and Barrick being the top two holdings. But to me, the main difference is if you look at the price, the expense ratio is 0.53 for GDX, and for Ring, it's only 0.39. Okay, so considering they have a similar portfolio, I'm personally investing in Ring to take advantage of the potential new gold bull market. Okay, now if you're strictly interested in buying shares rather than trade options like I do, you could potentially buy Newmont Corporation or gold, both of which actually also pay a dividend. Okay, now Newmont Corporation specifically increased their dividend from 14 cents a share to 25 cents a share, which is about a 71% increase, which also gives you a little idea of how well these miner stocks are doing because of the increase in gold prices. Okay, now what you need to understand too is this is not something that's going to happen overnight, because people have been predicting that gold can shoot up anytime, or that the stock market can crash at any point. But this could take up several years, which is why, like Ray Dalio recommends, you might want to put in maybe 5 or 10% for your portfolio in gold and let it appreciate over time. Okay, this is not something that you can pump and dump and make a quick 50% profit. Okay. But if you do want to trade options like I do, here's what I'm planning to do. Okay, I'm planning to buy call options on gold for January 15th, and if you actually look at the $40 call option, they're trading only at $59 per call option. Okay, so my plan is to buy a couple of call options on it. I may not necessarily wait all the way. I want it to appreciate, see where it goes. There's a good chance gold, ticker symbol gold, can go up a little bit, especially after Warren Buffett's news on Friday. It already shot up 7.5% on Friday after the news. So I'm going to keep an eye on it, potentially buy shares of Newmont too, because they're paying a dividend. And that's exactly how I'm planning to invest in gold, okay? So do your own research, try to understand why gold is a good asset to have in your portfolio, especially for diversification, and on top of taking advantage of the new gold bull market, potentially. Okay? So that's all I wanted to share with you guys for today. If you have any questions, please feel free to leave a comment below, and subscribe if you haven't already, and hit the notification bell to get notified of my future uploads, okay? Thanks again for watching, and until next time.